Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today we're looking at SoundHound AI.
If you find our talks useful, please consider subscribe, like, and comment underneath. But let's jump right into what might be, well, honestly, the most fascinating investing paradox in the market right now.
Oh, it really is. It's wild.
Right. Imagine looking at a company that is seeing just explosive, almost unbelievable revenue growth. I mean, we are talking up 127% year to date.
Which is huge.
It's massive.
Yeah.
But then, you pull up the stock chart, and it just looks like a total disaster zone. The stock is completely cratered, dropping roughly 66% from its all-time highs back in late 2025.
Yeah, it's definitely the ultimate head-scratcher for anyone watching the AI space right now.
Exactly. So what is going on here?
Well, it's a massive disconnect, and, our mission for this conversation is to unpack exactly what is going on beneath the surface for you. We really need to evaluate this recent, highly contested $7 support level.
Right, because everyone is wondering if this is a trap.
Exactly. Is this what traders call a falling knife, like a stock in free fall that will just cut your portfolio to shreds if you try to catch it?
Yeah.
Or is this actually a golden contrarian entry point?
I like the sound of a golden entry point.
Right. Well, to figure that out, we have to kind of bypass all the market noise. We need to determine if their stated path to profitability is built on a solid foundation or if it's just, a mirage.
Yeah, and we really need to start with the fundamental numbers here. Because, you usually do not see a stock take a 66% dive without some sort of catastrophic failure in the underlying business.
Usually no. You'd expect something terrible.
Right, but the numbers coming out of SoundHound AI's actual operations are staggering. They are in a classic high-growth acceleration phase. If you look at Q3 of 2025, revenue hit $42.1 million.
Yeah, which is a 67.6% increase year over year.
And what's wild is that this follows the 217% growth rate in Q2 of 2025. Sales have literally doubled from roughly $85 million in 2024 to an expected $169 million in 2025.
And didn't management just raise their full-year guidance too?
Yeah, they raised it to a midpoint of $172.5 million.
See, that guidance raise is a really critical signal. When a company is operating at this scale, hitting over $160 million in revenue, a guidance raise indicates that their adoption is moving way past niche experimental use cases.
It's becoming mainstream.
Exactly. They are landing scalable, highly integrated enterprise deployments.
But this is where the logic kind of breaks down for me, and why I think a lot of investors are incredibly skeptical right now.
Oh, for sure. The skepticism is loud.
Because think about this like a local business in your neighborhood. If you walk past a restaurant, the line's wrapped around the block, people are clamoring to get in, and the owner comes out and tells you, hey, our sales are doubling this year.
Sounds like a great business.
Right. But then you look up and see the actual market valuation of that restaurant has dropped by 2/3.
Yeah, that's the paradox.
You instantly assume something is fundamentally broken in the kitchen, right? Like health code violations, massive hidden debt, something.
Yeah.
The math just doesn't add up.
No, it doesn't.
So is this sell-off happening because the business model is secretly broken behind the scenes? Or are we just looking at an overreaction to, external factors?
Well, your restaurant analogy highlights the exact friction point the market is struggling with. Right now, investors are severely punishing the building, not the food.
Punishing the building. Okay, I like that.
Yeah, the selling pressure we are seeing is actually largely disconnected from their core operations. To really understand this, you have to look at the psychology and really the automated systems of institutional investors.
Right, the algorithms.
Exactly. So recently, SoundHound AI went through a CFO transition. Now, a chief financial officer can leave for entirely benign reasons, right? Retirement, a different career opportunity, maybe personal reasons.
Sure, people change jobs all the time.
But Wall Street algorithms and institutional risk managers, they don't wait to find out.
Right, because the sudden departure of the person managing the books automatically triggers a massive red flag in the risk models.
Yes, it forces a mandatory de-risking. The algorithmic trading systems literally hit the sell first, ask questions later button.
Which is brutal.
It is, but historically, a sudden CFO departure can occasionally precede an accounting restatement. So even when there is zero evidence of an accounting issue, which is exactly the case here, it introduces uncertainty.
And institutional capital hates uncertainty more than it hates actual bad news.
Oh, absolutely. They despise it. So when you combine that internal transition with the broader macro fears dominating the market right now, you get this crazy compounding effect.
Let's talk about those macro fears for a second, because it really feels like the entire software sector has been on edge lately.
Yeah, we are seeing a lot of anxiety about generative AI potentially disrupting traditional software as a service models.
Right, the idea that AI will just build the software for you, so why pay for a subscription?
Exactly. Investors are worried that AI will make certain software obsolete, so they're just indiscriminately pulling capital out of software stocks across the board.
Just a broad sell-off.
Yeah, and on top of that, you have geopolitical tensions in the Middle East causing sector-wide volatility.
Right, the flight to safety.
When money managers get nervous about global stability or energy prices, they pull their capital out of high-growth, high-multiple tech stocks and retreat to safe havens, like bonds or mega-cap value stocks. It's a broad, mechanical sell-off that just catches individual companies in the crossfire.
Okay, but if we are going to look at the full picture here, we have to confront the bear case head-on.
We do. We can't ignore it.
Because even if this sell-off is mechanically driven by algorithms and macro fears, we still have to ask for you, the listener, is this stock just too expensive?
That's the million-dollar question.
Right, because even after losing 66% of its value, the primary risk analysts are pointing to is valuation compression.
Yes, and valuation compression is the silent killer of growth portfolios. Currently, even down near the $7 level, SoundHound AI trades at a premium valuation of over 11 times forward enterprise value to revenue.
Or EV to rev, as we usually call it. Let's actually break that metric down for a second, because I know we usually talk about price to earnings or PE ratios. Why are we using enterprise value to revenue here?
We use EV to revenue for high-growth tech companies that aren't yet generating positive net income.
Because a PE ratio is pretty much useless if the earnings are negative, right?
Exactly. You can't divide by a negative number and get a meaningful valuation. So instead, we look at enterprise value. That calculates the total value of the company by taking its market cap, adding its total debt, and then subtracting its cash on hand.
So it's basically the true cost to buy the entire business outright today.
That's spot on. We take that true cost and divide it by their projected forward revenue. So right now, investors are paying $11 for every $1 of future sales SoundHound AI is expected to generate.
And to put that in perspective for you, the broader software sector median sits at less than 3 times forward revenue.
Which makes 11 times look huge.
Yeah. It is a staggering premium. I mean, if a stock falls 66%, loses 2/3 of its value, and is still trading at nearly 4 times the sector average, I really have to ask, weren't investors just living in a total fantasy land last year?
A lot of people are asking that exact question.
Because why should anyone pay an 11x premium today? Especially when you look at the threat of hyperscalers.
Right, big tech.
Yeah, you have Amazon, Google, Microsoft. They're spending tens of billions of dollars developing internal AI agent tools. So if you are an enterprise, why pay SoundHound AI when you can just use an Amazon Web Services tool? Doesn't big tech just crush the middleman eventually?
That is the core debate surrounding the stock right now. But an 11x EV to revenue multiple is only toxic if a company's growth decelerates.
Okay, explain that.
Well, if you have a traditional software vendor growing at, say, 10% or 15% a year, paying 11 times revenue is financial suicide, you'll never get a return. But SoundHound AI is growing at nearly 70% year over year.
Following a quarter of over 200% growth.
Right. When your top-line revenue compounds that aggressively, you mathematically grow into that premium valuation very, very quickly.
So the multiple shrinks as the revenue explodes.
Exactly. The reason they command that multiple isn't just hype. It's a reflection of a highly specialized competitive moat that the big tech hyperscalers are genuinely struggling to replicate.
Wait, really? A moat that Amazon and Google are struggling to replicate? That is a bold claim.
It sounds crazy, but it's true.
Because usually when massive tech conglomerates decide they want to dominate a specific space, they just leverage their unlimited capital to bury the competition. What exactly is SoundHound AI doing technologically that prevents a company like Amazon from just cloning their product and offering it for cheaper?
It comes down to the fundamental architecture of their technology, specifically 2 concepts, speech-to-meaning and agentic AI, processed at the edge.
Processed at the edge. Okay, break that down for us.
Think about how a standard big tech voice assistant works today. If you ask a smart speaker to change the temperature or order a product, your voice is recorded, compressed into an audio file, and sent over the internet to a massive centralized data center.
Somewhere in Nevada or Virginia, right?
Exactly. A generic language model parses the text, figures out what you want, and sends the command back over the internet.
Which takes a second or two.
Right. That required round trip creates latency. It takes time. SoundHound AI completely bypasses that cloud infrastructure. They process the voice data locally, directly on the device at what we call the edge.
Okay, so using a cloud-based AI is essentially like writing down a request, mailing a letter across the country to a central dispatch office, and then waiting for them to mail the instructions back to you.
Yeah, that's a great way to look at it.
It works, but it's inherently delayed. Using Edge AI, on the other hand, is like having a genius navigator sitting right in the passenger seat of your car.
Yes.
The processing happens in the vehicle with you, giving you the answer instantly without relying on a distant server.
That is the perfect way to visualize the architecture. And in latency-sensitive environments, that speed is not just a luxury, it is the entire product.
Right, like if you're driving.
Exactly. If you are driving a car at 70 miles per hour and need to adjust navigation, or if you are running a high-volume fast food drive-thru with cars backed up into the street, you cannot afford a 2-second cloud processing delay.
It totally ruins the user experience. People get frustrated.
They do. SoundHound AI enables sub-second instantaneous responses because the compute happens locally. But they've recently taken this a massive step further with the rollout of their Amelia 7 platform.
Which is their new enterprise system.
Right. And this isn't just a transcription service. This is agentic AI.
What is the mechanical difference between a standard voice AI and agentic AI?
So a standard AI chatbot can tell you the weather or read a menu. It just retrieves information.
Okay.
Agentic AI is autonomous. It can interface with legacy enterprise databases to execute complex physical or digital actions.
Give me an example of that in the real world.
Sure. If a customer is in a drive-thru and says, I want the combo, but swap the fries for onion rings, take off the tomatoes, and add a side of ranch.
A nightmare order for a human cashier.
Exactly. The Amelia 7 platform doesn't just understand the complex natural language. It actually communicates securely with the restaurant's point-of-sale system, modifies the inventory in real time, and sends the custom ticket to the kitchen display, all without human intervention.
Wow. And once you embed an autonomous agent that deeply into a company's core operational workflow, handling their customer service, routing their drive-thru orders, managing the thousands of calls hitting their call centers, you create an incredibly sticky product.
The stickiest.
The switching costs become massive. I mean, a global restaurant chain is not going to rip out their entire point-of-sale integration just to save a fraction of a penny per query using a generic Amazon alternative.
No, especially if it introduces cloud latency and ruins their drive-thru times. It would cost them more in lost efficiency than they'd save on software.
You've just identified the exact reason they have been able to build a $1.2 billion customer backlog.
Yeah, and we need to emphasize that number isn't a projection. It is contracted future revenue from major enterprises that have validated this technology and are actively locking them in for multi-year deals.
The $1.2 billion backlog is a fantastic safety net. But having incredible edge computing tech and a massive backlog brings us to the most critical hurdle for any high-growth tech stock, which is the cash burn.
Yeah, the elephant in the room.
Because developing proprietary AI is brutally expensive, and you cannot pay your server bills or your engineering teams with a backlog.
You really can't.
At some point, the conversation has to shift from pure growth to actual profitability. SoundHound AI has to prove they can stop bleeding cash and start generating positive returns.
And this is the exact inflection point that the broader market is mispricing right now. If you look at their current financial statements, the company is unprofitable on a GAAP basis.
Okay, let's define GAAP for a moment for anyone who needs a refresher.
Yeah.
It's generally accepted accounting principles. When a company reports GAAP losses, it includes all of their non-cash expenses, right? Things like the stock options they give to their engineers, depreciation of assets, all of that gets factored in to make the losses look worse on paper.
Correct. GAAP is the standard, rigid way of reporting accounting. But if you look under the hood at their operational efficiency, they are hitting a massive turning point.
What are we looking at specifically?
Their GAAP gross margins. So the profit they make on their services before accounting for overall business overhead, those margins are expanding rapidly. They jump from 39% in Q2 of 2025 to 43% in Q3 of 2025.
Wait, a 4% margin expansion in a single quarter? That is a massive leap for a company valued at this size.
It's huge.
How are they achieving that? Are they just strong-arming their clients and aggressively raising prices?
No, not at all. It's actually driven by internal engineering efficiency, which is a much healthier way to expand margins.
Okay, how so?
They are aggressively rolling out and integrating their proprietary Polaris voice technology. Right. Historically, to process these complex voice commands, SoundHound AI had to rely on a sort of patchwork of higher-cost third-party
I
components.
see.
Every time they processed a query, a fraction of that revenue had to be paid out in licensing or API fees to someone else. It was a variable cost that just ate into their profits.
So as they grew, their expenses grew right alongside them.
Exactly. But Polaris changes that entirely. Polaris is their own foundational AI model. It replaces those external third-party components.
So they don't have to pay the toll troll anymore.
Exactly. Because they now own the intellectual property end-to-end, those external variable costs disappear. The marginal cost of processing a new voice query drops dramatically.
Well, if the marginal cost is dropping, that means every new dollar of revenue is drastically more profitable than the last. So what does this actually mean for the bottom line?
It means they are on the verge of making real money. Management's guidance is pointing straight toward EBITDA break-in.
And for those less familiar, EBITDA stands for earnings before interest, taxes, depreciation, and amortization. It is essentially the truest measure of a company's core operational cash flow.
Right, it strips away the accounting noise. And just yesterday, April 7th, 2026, reports hit the wire confirming a major profitability inflection in Q4 2025.
That is massive news.
It is. When you connect this margin expansion to their $5 billion market cap, you start to see why this is the holy grail for a scaling tech firm.
Because of operating leverage.
Yes. Developing this proprietary tech requires astronomical fixed costs, paying specialized AI developers, building the infrastructure, running all the research.
It's hundreds of millions of dollars.
Exactly. But once those massive fixed costs are covered and you implement a proprietary system like Polaris, the operating leverage kicks in. That means when they pull a new enterprise contract from that $1.2 billion backlog, the vast majority of that revenue drops straight to the bottom line as pure profit.
Because the heavy lifting is already paid for.
Precisely.
Okay, but we also need to evaluate their financial safety net while they sprint toward that profitability finish line.
Right, the balance sheet.
Because the biggest fear investors have with unprofitable tech stocks is dilution. If a company runs out of money, they have to issue millions of new shares, which just dilutes the value of the stock you currently own.
It's a very real fear in this sector.
But looking at the balance sheet, SoundHound AI has a $200 million cash runway available out of the $721 million in total funding they've raised historically.
Yeah, and that $200 million acts as a massive buffer.
It means they have the capital required to cross into profitability without having to pass the hat around to Wall Street and heavily dilute their current shareholders over the next 6 months.
The dilution risk here is drastically minimized compared to their peers. They genuinely have the runway to execute.
So we've established the fundamental reality here. The hypergrowth is real. The localized edge computing moat is locking in enterprise customers. The integration of Polaris is actively expanding margins, and the profitability inflection is imminent.
The business is firing on all cylinders.
But the disconnect between the business and the stock price is clear. So let's talk strategy. How should an investor practically view this setup over the next 3 to 6 months? Let's look at the technicals, the shifting sentiment, and the upcoming catalysts that could, force the market to wake up.
Yeah, let's look at the charts. From a purely technical standpoint, the stock is deeply oversold. It has been hammered relentlessly down to the $7 level.
It's been tough to watch.
It has. But $7 is acting as a major psychological make-or-break support zone. And what the trading volume shows us is that the downside momentum is exhibiting clear signs of exhaustion.
Meaning the sellers are done.
Basically. The panic selling has largely run its course, the weak hands have exited, and the sellers are simply running out of shares to dump.
And we are seeing the institutional sentiment begin to shift, literally as of yesterday. A major analyst upgrade to a strong buy was issued.
Yeah, that was a big deal.
This is the first signal that Wall Street analysts are diverging from the bearish price trend. The stock is starting to populate on those heavily watched, overlooked AI stocks lists. The narrative is beginning to pivot from fear to opportunity.
And that shifting sentiment aligns perfectly with the catalyst calendar for the next 3 months. Because, a stock can sit at support forever unless there is a catalyst to force a repricing.
Right.
The most significant event looming on the horizon is the upcoming Q1 2026 earnings report.
Think about the psychological setup going into these earnings for a second. The stock price has cratered 66%. During that multi-month slide, Wall Street analysts have quietly lowered their consensus estimates to match the prevailing gloom and doom.
They've set the bar incredibly low.
They have artificially lowered the bar for success. So if SoundHound AI simply executes on the massive backlog they already have contracted, it creates the perfect environment for a massive beat-and-raise scenario.
Exactly, where they shatter the lowered expectations and issue stronger guidance.
It's a classic contrarian setup.
Furthermore, you have the ongoing commercial rollout of the Amelia 7 platform, combined with the integration of their recent Interactions LLC acquisition.
Right, which people have kind of forgotten about.
The market has completely ignored the potential revenue synergies from that acquisition. As they fold that new tech into their agentic platform, it's going to drive cross-selling opportunities that simply aren't factored into the current $5 billion valuation.
We also have to zoom out and look at the macro environment, specifically the Federal Reserve.
Always the Fed?
Fed Chair Powell recently made comments heavily downplaying the need for future interest rate hikes. Now, why does the Federal Reserve matter so much to an AI software company?
It's all about valuation models.
Exactly. High-growth tech stocks are valued using a discounted cash flow model. You project their future profits and discount them back to today's value based on interest rates.
Right.
When the Fed signals a dovish stance and indicates rates will remain steady or move lower, the discount rate applied to those future profits drops.
Which mathematically makes the company's future cash flows significantly more valuable today.
It is a massive macroeconomic tailwind pushing at their back.
And finally, we just can't ignore the speculative chatter that naturally arises in these situations.
The buyout rumors.
Yeah, M&A target speculation. You have a recognized leader in Edge Voice AI. They own proprietary, highly defensible technology. They have a $1.2 billion backlog of Tier 1 enterprise clients.
And they're essentially on sale.
Exactly. They are trading at multi-year support levels after a severe haircut. That combination makes them a highly attractive theoretical M&A target.
Because larger, cash-rich tech players who missed the boat on edge processing could easily look at this depressed valuation and decide that buying SoundHound AI outright is the fastest shortcut to catching up in the AI arms race.
It makes a lot of strategic sense for a big tech player.
So when you lay all of these pieces on the table, the setup is incredibly compelling. You have a stock that the market has priced for absolute disaster, sitting right on a critical $7 support line. Yet underneath the hood, you have a confirmed profitability inflection in Q4, a rapidly expanding gross margin profile thanks to their Polaris tech, a massive competitive moat with sticky enterprise switching costs, and a dovish Federal Reserve providing macro support. The disconnect between the 66% drop in share price and the 127% year-to-date revenue growth is just wild.
It is one of the most asymmetrical setups in the software space right now. So to kind of synthesize this into a final investment thesis for you, if you are looking at a 3 to 6 month swing trade horizon, this stock earns a bullish 7 out of 10 score.
A 7 out of 10, okay.
Yes. It is vital to acknowledge the moderate risks, obviously specifically the threat of long-term valuation compression and the ever-present shadow of hyperscaler competition.
Big tech is always looming.
Right. But fundamentally, this is a beaten-down growth story, where the broader market is entirely mispricing the safety provided by that $1.2 billion backlog. When the upcoming Q1 and Q2 earnings reports formally confirm their shift into sustained profitability, the market will be forced to reevaluate. The contrarian entry point here offers an exceptional risk-to-reward ratio.
I want to leave you with a final lingering thought to ponder as you research this space on your own, building on this idea of an edge computing moat.
Oh, this is interesting.
We've talked extensively today about the Amelia 7 platform and how it handles fast food orders and automotive navigation. But zoom out 10 years for me.
Sure.
If agentic AI continues to evolve, becoming fully autonomous and completely embedded into the operational workflows of every drive-thru you visit, every customer service call center you dial, every smart appliance in your home, and every car on the road.
Which is where we're heading.
Exactly. Creating insurmountable switching costs for these massive corporations. Does SoundHound AI eventually stop being viewed as just a software vendor?
What do you mean?
Do they instead become an invisible, unavoidable utility layer for the entire global service economy? A literal toll booth for human-to-machine interaction.
Oh, wow. A toll booth for voice AI.
Right. And if they achieve that status, evaluating them at 11 times revenue right now might eventually look like the bargain of the decade.
It really might.
It's definitely something to seriously think about. Thank you for tuning into today's stock analysis, and keep that wealth-building mindset sharp.